My name is Dave Aquino, and I'm the Options Live Trading Room Specialist here at Microquant. Tonight's webinar is focused on trading equity options with value bars and MQ momentum. Tonight I'm going to go ahead and touch on and review some fundamental value charts and MQ momentum sweep indicators and how they work. Then I will go into a brief primer on options and discuss how we use them. Then I will show you an options trade setup that we regularly use in our Options Live Trading Room and then demonstrate it on some past charts. If you think of any questions at all during my presentation, please go ahead and submit all questions via the GoToWebinar side menu. We'll try to answer all submitted questions in the question and answer segment at the end of the presentation, and we'll make sure that all questions will be addressed. Risk disclaimer. We at Microquant want you to know that trading or investing carries a high level of risk, and it is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time and without notice, and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content, or from an inability to access such information, or any delay in or failure of the transmission or the receipt of any instruction or notification in connection herewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. CFTC Rule 4.41. This is a U.S. government required disclaimer. CFTC wants you to know that futures and options trading not only has large potential rewards, but also large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Do not trade with money you cannot afford to lose. This is neither a solicitation or an offer to buy or sell securities, futures, or options on the same. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website. The past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions on either of these two disclaimers, feel free to go ahead and contact us at Microquant. Okay, now moving on to the topic of tonight's webinar, trading equity options with value bars and MQ momentum. Again, tonight I'm going to first be talking about the indicators used in options trading, primarily value bars and value charts, and then also MQ momentum indicator. Secondly, I'm going to introduce you to trading options on stocks and how to use them in your trading. Thirdly, I will discuss the price momentum divergence setup and then show you how to find them on stock charts and then how to trade them with options. Now, before we start talking about our indicators and setups, I would like to touch on what we believe are the three most important components of technical analysis: price, value, and momentum. By combining all three components together, we believe it provides the most complete view of the current makeup of any market. The tools that we're going to use to gauge these three components will be, for price, we're going to use the traditional price charts you're familiar with, or the open, high, low, close bar charts. For value, we're going to be using our proprietary indicator value charts, and by extension, our value bars indicator. And for momentum, we will use our MQ momentum indicator. Now the settings we're going to use for our indicators are for value charts and value bars, we're going to use a 5-bar analysis period. For MQ momentum, we're going to use the default 3255 setting. And later on when you're looking at our chart examples, you'll see 2 trend following MQ indicators. MQ regression, which we'll have set at a 100-bar analysis period, and MQ trend, and that will be set at a 21-21-3 setting. Okay, I first want to talk about the nature of value charts. Value charts were created to provide an objective evaluation of the current price based on real past prices within an analysis period. This is a very important distinction because usually in the financial industry, when we talk about value, we're talking about something like value mutual funds. And that idea of value is purely subjective. Subjective to one person, being the analyst, his opinion on a stock or a company and whether or not it's undervalued or overvalued. But that is the traditional definition of value. What we provide with value charts is an objective valuation. It's independent of opinion. It's based on historical real prices that actually occurred. So through value charts, prices are placed within 5 primary value zones. The first zone is this green zone in the center here, and it represents fair value. Above and below the green zone, we have these yellow zones, and this is moderately overvalued, and below we have moderately undervalued. Then above and below the yellow zones are the red extreme value zones. This is significantly overvalued, and this is significantly undervalued. Now, historically, prices have existed within the fair value zone roughly 66% of the time. Now, in the yellow value zones, up above here, in the moderately overvalued level, prices have been in this zone roughly 16% of the time. I apologize for my penmanship. It's hard to write with a mouse. And then concurrently, in the lower yellow value zone, prices are also in that zone roughly 16% of the time. Now, in the red, significantly overvalued and significantly undervalued zones, prices are in these red extreme zones only 1 to 2.5% of the time combined. Now, these percentages can vary slightly depending on the markets you trade and your particular indicator settings, but as you can see, prices tend to stay within fair value, but periodically they enter moderately overvalued and moderately undervalued levels, as well as significantly overvalued and significantly undervalued levels. Now, what you see here is our traditional open, high, low, close bar chart. These charts have been used for hundreds of years, and basically they're a good representation of price over time. Each bar represents price movement within a specific period of time, or for a specific number of transactions, or ticks. Now each bar is made up of this left horizontal bar, that's the opening price, and this right horizontal price, that is the closing price. Now between that we have the very top of the bar is the high of the bar, and then the low price of the bar at the bottom, and then they just connect the lines. So basically that is what makes up one of these bars. Now what we see here again is the traditional open, high, low, close bar chart combined with our value charts indicator. Again, the open, high, low, close bars shows the current as well as the historical price history. Now what you see here on the value chart is that we see where prices fall within the 5 valuation zones we just talked about. And you can see here when prices are in this extreme upper red zone, this is significantly overvalued. Prices that are in the moderately overvalued yellow zone, that corresponds to these prices right in here. And you can see here, right in this area, that prices predominantly stay within the fair value zone, this area here. Now as prices come up and come down, they go through the fair value zone and then they enter this moderately undervalued zone right here. And then as prices reach their other extreme, it's in the lower red valuation zone or significantly undervalued. Now, one thing to note as I was going through that, you notice that it's very difficult to see both price and value at the same time on two different charts. And this is especially difficult in fast-moving markets. So that's why we developed value bars. Now you can see both price and value on the same chart. The prices are still shown within the traditional open, high, low, close format, but now the bars are actually color-coded so that you can see where the price lies within the 5 valuation zones. Take, for instance, this particular bar here. You can see the bottom third is in the green zone, the fair value zone. The middle third, or a little bit more, is actually in moderately overvalued, the yellow zone, and the tip here at the top is in significantly overvalued levels. You can see now how this greatly aids in helping you identifying both price and value very quickly. Now for the third component of technical analysis, momentum, or more specifically, the momentum of price movement. The tool that we're going to use is the MQ momentum indicator. What MQ momentum does is it seeks to gauge the momentum of a market, which is basically the strength of a market as it moves in one direction or another. Now this is very similar to a moving average convergence divergence indicator, MACD, or some people call it MACD, but MQ momentum is actually a proprietary indicator designed by Mark Helwig. Now Mark took components of his favorite momentum indicators and basically created a hybrid that kept the most important momentum factors together. Now when you look at the indicator, MQ momentum is made up of this solid blue line right here. That is the indicator line. Then the other line is this dotted line, which is the slow or trailing line. And the third component is this histogram right here, which basically shows you the spread between the two indicator lines. Now, basically, when price momentum is bullish, the indicator line is moving up. And then the histogram is both positive and green. When price momentum is bearish, you see the indicator line moves down. And the histogram is both negative and red. This way, you can see that MQ momentum provides a real-time view of both direction and strength of price momentum in a market. Okay. Let me just take a quick look at the questions here. I think someone posed a question specifically regarding value bars and value charts. They measure the same thing. They place price within the 5 valuation zones, but it appears a little differently. If you look here, do you see how everything is kind of flattened out so that the middle section is in green, the yellow section is above that, and another yellow section is below that, and then the red valuation zones are at the extreme tops. Basically what we do is we apply the colors to the open, high, low, close bars. Now as prices move up and down, the value will change, and it's not a direct linear arrangement like this, but the measurement of value is the same. That the tips down, the lower ends down here will be the same as the lower end, the extreme value zones right here. Okay? I hope that answers your question. So moving on to our next section, I want to start talking about a topic that I'm very excited about, and it's my options live trading room, are options. What are they? Basically, options can be thought of as trading vehicles that derive their value from characteristics of an underlying stock. These characteristics are price, the implied volatility of the price movement of the stock, and the time until expiration of the option. Now, options also have aspects that are desired by options investors. The two aspects that we're going to talk about tonight is leverage and defined risk. Okay? These characteristics and aspects of trading options are another layer of complexity that we talk about in the options live trading room. But for the purposes of this webinar, we want to go ahead and discuss how do we trade options. Excuse me. Options in general provide lots of trading tools that we can utilize in a large number of option strategies. But for tonight's webinar, we're going to keep things a little basic. We're going to be discussing calls and puts as directional options trades. Basically, when we believe that the stock price is going up, we go buy or go long call options. When we believe that the stock price is going down, we buy or go long put options. It's very straightforward. Basically, what we're doing is utilizing options as a leveraged substitute for owning stock. Okay, this is one of those aspects, leverage of options that we're taking advantage of. Okay, the next question that comes to mind is, now which option do we trade? If you've ever given any thoughts to trading options, you've probably gone to your trading order system and pulled up an options chain on a stock and seen the large number of options available to trade. For each group of options that share a specific expiration date, there are any number of call and put options available at many different strike prices. As you can see here, this is a screenshot of the current options available for Apple. Now, this is a screenshot of the Thinkorswim ordering system. Some of you may be familiar with that. That's what I primarily use. Right here is the days until expiration date of this set of options. The calls are usually listed on the left side. The puts are listed on the right side. And then here you see all the strike prices that they share. Okay. Now, the next question that comes to mind is, now which option in those chains do we trade? Which strike price do we buy? For the purposes of what we're talking about, buying and selling calls and puts, for tonight we're going to be utilizing the Delta 70 in the money calls and puts. I'll go in and explain what that means, Delta 70, in a second. Now, for expiration dates, for high volume stocks that have weekly options that are issued every week and expire on Friday, we're going to look for weekly options that have anywhere from 2 through 8 days until expiration. Now, for stocks that don't have weekly options, we'll go ahead and select the current month option. Those usually have anywhere from 2 through 30 days until expiration. Again, we can see this on the option chart. Okay, specifically, again, this is the number of days until expiration. Again, calls on the left side, puts on the right side. Now, this again is the option chain. The column that we're interested in is right here. It says delta for calls and delta for puts. You can notice first for calls, these numbers right here that are circled. We have a 0.67, 0.77, 0.84, 0.89. We're actually looking for a delta 70, so that's 0.70. We don't have to get exactly there, but we can get close to it. So the one I would actually pick for myself is probably this delta, this 0.77 or delta 77 option. That's the one I would select for calls if I'm bullish on a stock. Now for, and you can see that this option is actually trading at this price right here, $13.23 a contract. Now if I was bearish and I want to go ahead and purchase a delta 70 put, I do the same thing. I look under the delta column, I find that these three are close by, and I would select this negative delta or negative 0.74 number. And that is the put that I'm going to select, and it's currently trading for $11.15 right there. Okay, so that is how we go about selecting the actual option that we're going to trade. Now, the one aspect of trading options on stocks that you need to wrap your mind around is that when we evaluate a stock, we are looking at for trading setup signals based on the price chart of the underlying stock. We identify the buying point, we identify where we're going to put our stop loss, where we're going to exit, or where's our profit target, etc. Everything's based on the price chart of the underlying stock. Now, once we go ahead and commit to making a trading decision and buying and selling a position, then you actually enter all buy and sell orders on the actual Delta 70 option price. Remember, I showed you that in the options chain. This is what I'm going to be buying, and this is what I'm eventually going to be selling. Okay? Now, the best way to demonstrate this is actually work through an example. Okay? Let's just say it's Wednesday morning, and then you see a setup in Google, you're bullish on it. Google is currently trading at $900 a share, and you believe, based on your valuation, you believe that Google can go to $910 over the next couple of hours, or maybe by tomorrow. So you go ahead and buy a Delta 70 call option, which is currently priced at $20 a contract. Now, later in the afternoon, you check your Google price, and Google is at $910. So basically what's happened, the Google stock price has increased by $10. Now you check your Delta 70 call that you purchased, and you see that the value of that call has increased by a factor of $10 times 0.70. This is where the Delta 70 or those other decimals that came into play, 0.70. So that the value of your call has increased by $7. Now your Delta 70 call is now trading at $27. That is a 35% return on an investment that you made earlier this morning. And that is a very good example of the power of leverage we have with options on stocks. Okay? So the next phase I'm going to go into is basically show you the price momentum divergence setup. I'm going to show it to you on stock charts, and then I'm going to walk you through how we're going to execute this trade with options. I've already showed you how we mentally work through it, and you can see how the profits and losses work. But this way we're going to show you an example of a setup and then work through it. So the first question is, what is a divergence? The best way to visualize a divergence is actually to look at an example on a chart. Okay, this is a chart of Apple. It's a daily chart, and what we're going to do here is show you a bearish divergence. Okay, so what we have are stock prices that are moving up. They come up, they make a high here, and then they start to come back. Okay, now this first high corresponds to this area on the MQ momentum histogram. Excuse me. You see that right there? You can see that the histogram reaches this level of height, and the indicator line reaches this level of height. So as prices come up, they pull back. Now, as prices move back up, they reach an equally high level, and then in this case, they continue on and make new highs right here. Okay, this is high number 2. Now, when you look down and check your indicator, you can see here on the MQ Momentum's histogram that they don't really make the same height as the previous high histogram area. And we check the indicator lines, it's a little bit lower than this area over here. So what we basically have is prices making a high and then moving higher. We have the histogram or the indicator of MQ Momentum, and both the histogram and the indicator line making highs right here, but whereas the price is making new highs, the indicators itself is actually not reaching the same level of height as the previous area of the momentum. So these are actually a little bit lower. So what you have is price diverging from the momentum indicator. Okay, so that is the setup that we would actually be taking. Let me work through it as an actual trade for you. Okay, I'm going to erase the ink so I can show you this here. Okay, let's just say we're looking for a longer term trade that might last a couple of weeks, and it would be basically what we'd be looking to do on a daily chart. Well, not really a couple of weeks, but maybe within this course of 3 to 5 days. So we see Apple prices coming up, and then they make this high right here at this point. Okay, again, the histogram makes increases to about this level right here. Now prices pull back, and we're watching them, and we see prices come up. They surpass the previous high and continue on to make new highs here. Now as we start seeing the prices start topping a little bit, we start looking and watching for a divergence. We see the histogram is not nearly as high as the previous level, and the indicator line is slightly lower. So what we will do at this point here is go ahead and purchase a Delta 70 put, okay? Because we are bearish on this, and because of the bearish divergence, we're looking for prices to fall. Now we'll purchase the Delta 70 put, and we will look at the chart and pick a point, maybe $2 to $3 above the price of Apple as the place where we're going to go ahead and put the stop loss. Okay, and once we have our order in place, we'll go ahead and monitor the trade. The prices actually do work out the way we think they're going to work out, and then they start to fall. It's a little covered by my MQ regression indicator here, but prices reach the 8 EMA or 8 exponential moving average right here. So we move our stop loss from this point here to break even here. And what we do as prices continue to go down, we actually look to sell and take our profits here at the lower yellow bar segments, or opposite from where we got in. Okay, I hope that's a little clear. That's the trade. So basically, when we're entering the new high right here, the second high, we see the divergence. We go ahead and take a bearish position. We purchase a Delta 70 put, and basically then we're looking for prices to fall. We set the stop loss here based on the daily chart, and then as prices fall, once we hit the 8 EMA, we'll go ahead and move our stop loss to break even, so that cuts our risk, and then we'll watch the position as it continues on down, and we take profits in this area right here. So basically, the price difference on Apple from where we entered it to where we sell it times 0.70, and that will be the increase in our Delta 70 put. Okay. Let's see here. There's a quick question here. I'm not seeing what benefit value bars are giving. They're well before. Sure. I understand that. Let's take a look here. Let me clear some of these erasing bars. Well, value bars. The question is can I clarify a little bit the benefits of having value bars on this trading system? Value bars are an indication of the value relative to the previous prices. Where does this point right here, where does that fall in relation to what's previously happened? Okay, basically what we're doing is value bars provide us the relative value of that price based on what's happened in the past. As you can see, predominantly the prices have been down here. Now when the market starts to really move up, we see that we hit moderately overvalued levels. Okay, sometimes that has to do with the speed at which prices increase, but also the just in general terms, the historical prices that we're comparing to. Now, the value bars themselves, especially with its moderately overvalued, shows that prices are becoming overvalued, but that is not necessarily a buy or sell signal themselves. I know sometimes there are people that use our value charts indicators and they say, well, you know, if it's red, you sell or something like that. It's not the case. You have to interpret the idea of value and how it pertains to where prices are currently at right here. Now, it does give us some indication of the fact that prices are not going to be in this yellow price zone very long, okay? So that it aids us in making a determination of the actual setup itself. In this area, we're looking at prices. Prices move up and then they fall back. Prices move up again and then they start to fall back. This doesn't necessarily tell me to sell because I just see that these are moderately overvalued. Okay, what tells me to sell is the actual setup. It's value charts as well as these value bars. MQ momentum, and it's the actual signal is the divergence in comparing the price move prices moving from a lower price to a higher price compared to the momentum showing a relatively high level here, but a much lower level here compared to what prices are doing. So that is the sell signal. It's not the color of the bars. Okay, there's one example where it does affect it, and I'll show you. Okay, again, because it helps us understand where these prices fall in relation to what has historically happened. Okay, so that's an important distinction. Let me go ahead and move on, and I think it will help you see that also. Okay, here's another chart example. This is Google on a weekly chart. Okay, this is a much longer type of trade, but it's still a good example of what we're talking about. Okay, so we see prices in Google making some highs right here. The MQ momentum histogram is showing a good, strong showing here based on this price movement here. The indicator line is way up here. Okay, that's the first set of price and momentum measurements. Now prices come back and they make this nice long run up here to this culminating in this point right here. Do you see that red upper bar segment? That's actually going to be important, and I'll explain why. So you see prices move up, and then we look at the indicator to see what it's done, and you can see that the indicator that corresponds to the second move higher to new high prices is much lower than the first set of indicators right here. The indicator line also fails to reach an equally high height or exceed the previous histogram bars or indicator line. So there again we have a price versus momentum divergence. Now specifically I pointed out this red upper bar segment on this particular bar. When we do price earnings, price momentum divergences, the one signal that gives us actually a lot of support for this being a bearish divergence is the fact that we have this extreme value level. If you remember on the value charts diagram that had the 5 zones, I said prices in the extreme value level are only there 1 to 2.5% of the time for both the extreme high red area significantly overvalued, and then the lower red significantly undervalued. So this is actually a very bright beacon saying this is probably not going to persist, so that prices are not going to stay red hot like this for long. So this is an indication you can actually take that we can go ahead and go short right here on this bar. So you can go short, and in this case, like we're going to pursue the same type of options trade. Let's say Google on a weekly contract. Again, this is the second set of highs. We see the divergence. We see the upper red bar segment. We go ahead and purchase a Delta 70 put again. Okay. Now, sorry. My handwriting is not that bad, I promise you. So we purchase a Delta 70 put and we follow the same criteria. We set the stop loss again several dollars above this current price where we get in. We follow prices as they continue to descend. We go ahead and move our stop loss to break even once we hit the 8 EMA, and then we look to exit the trade with a profit target at the opposite value level here, significantly undervalued. So that again would have turned out to be a successful trade right there. Okay. All right, we'll go on to the next one, and I've shown you two bearish divergences. Let's take a look at this one here. This is MasterCard on a 5-minute chart. Okay, so what we see with MasterCard, we see prices moving up, prices moving down, and in this particular case, what catches our eye is this movement down right here. We look at the MQ momentum histogram, we see that prices move down right here. So that this low corresponds to this low on the MQ momentum histogram, and then this low on the indicator line. Okay, so prices move back up, and then they trend along, and then what you see is this one big bar right here. It's crazy to see this one big bar. So what we're looking for in a divergence, we're looking for prices that are equally low or lower. In this case, it not only goes a little bit lower, but we have this lower red bar segment again, just like we did on the previous chart. We check the indicator, and this is what we see. We see the histogram only reaching down this far. Okay, the indicator line's about the same, but really compare the histogram on low 1 to the histogram on this low 2 right here. There's one big spike. Right here is a very good opportunity to go long. So you're bullish here. Okay, so we go ahead and purchase a Delta 70. Oh boy, that's terrible. Delta 70 call. Okay, and you can see price. I mean, this is a 5-minute chart. You have to be ready. Go ahead and purchase that call because prices jump up very quickly from that extreme valuation level. They jump up, and we can see we hit the 8 EMA on the very next bar, and then we trend sideways for a little bit, and then we hit this opposite moderately overvalued level, and then we go ahead and sell here. Okay, that, if you caught it and were quick, is a very good trade, because I mean, you're just going along, you're looking for this to roll back down, but all of a sudden it jumps down. Extreme red valuation zone is significantly undervalued. You can check the histogram. Wow, that's really very shallow compared to this down move in the histogram. So you go ahead and buy that Delta 70 call, move to break even, and then go ahead and sell it here at the other extreme. So this is an example of a bullish divergence. Sure. The question that someone posed, and I know I did ask this, I would address this in the question and answers area, but I think it's a little important here. Someone asked, why do we use the Delta 70 call? Okay. Sorry, I'm diverging from my my topic here, but I really want to jump back. This is a very good question. Why do we buy these Delta 70 calls? Whereas you see that's trading for $13.23. I can come down here and buy a Delta 10 for 70 cents. That's much cheaper than this $13.23, right? Well, the first thing is liquidity. Now with Apple, you're going to be liquid wherever you are. But in general, if you're trading something like General Motors, Walmart, things like that, you're not going to have very much liquidity in the a Delta 10 contract. But think about it. In order for you to make money on this trade, if the price of Apple moves $1, you only make 10 cents. Okay? Now, another thing too, it's quoted at 0.70 is the last price, but look at the bid and the ask. It's pretty wide. Again, Apple's not the best example of this because, again, Apple is extremely liquid. That's why we trade it a lot in the options live trading room. But in general, it's because you need to have a tremendous amount of movement in the stock to make it worthwhile in the price of the option. Okay? So because in the example here, the calls, they're in the money, that if we move $1 in Apple, which can happen basically, over the course of a couple of minutes very easily, our option gains 77 cents. Okay. Now, it's much easier to have price movement with a delta 70. Now, one other thing that I want to show you that we talk about in our options live trading room, if you are correctly purchasing an option and it moves in the direction you think it's going to move in, do you see these other option chains, delta 84, delta 89, delta 92? If you are correct, your option actually moves greater into the money. So the delta of your option that you purchase will go from delta 77, delta 78, etc., etc. It will actually increase. So it's almost like you're getting some additional compounding in the increase every time you are more in the money. It's a little hard to explain, but that factor is actually called gamma, which is the rate at which delta changes. It's like the second derivative, and I don't want to really get into it. It's kind of complicated, but basically is you'll be paid more as you become more correct, if that kind of makes sense. So again, I really don't necessarily like trading these really cheap options. Again, with Apple, it's not a problem because they're highly liquid. But if you're trading General Motors, don't buy the Delta 10. Don't buy the Delta 20. It'll, and plus, if it gets really close to expiration, the value of these just drop off because they're so far from the current price. That's another thing. So come to the Options Live Trading Room. I'll teach you all about it. So if you don't mind, I'm going to go ahead and jump back now to the chart examples. Again, we were right here. This is a bullish divergence. And again, we buy the Delta 70 call here, and we sell it up here. Okay? All right. So those three charts that I just showed you, it was a daily, a weekly, and a 5-minute. One other type of chart that we trade in the Options Live Trading Room, we like to do this at the open, is a tick chart. And basically, remember I showed you an open, high, low, close bar. This bar represents not a specific duration of time, but it actually represents a number of contracts that are actually bought and sold, the number of ticks. So they actually provide a little bit better understanding of what's going on in the price of a stock when you deal with it at the open. Okay? So we trade tick charts on Apple, Amazon, and Google every morning. We watch them. We look for these types of trades. It's a little different from the one I'm going to show you, but this is basically the chart we look at in the morning. But again, this is a tick chart. Let's look for divergences. So we see the prices moving up here. This makes high number 1. We look at the corresponding momentum indicator, and it makes a nice relative high right here. The height of the indicator line is right here. Okay? Then we continue watch it. It pulls back. The options price of the underlying moves back up. Great. So this is high number 2. Let's check the indicator. Okay. Now the indicator histogram did not make nearly as high highs. This is a little bit about the same, but we do have a divergence in the histogram. So we can go ahead and go short right here. We can purchase a Delta 70. When I say short, I'm sorry. We can be bearish here. So we buy a Delta 70 put. Okay? We follow the trade. We put the stop loss here. Prices come down. They touch the 8 EMA right there. And we'll go ahead and move our stop loss to break even. Now we're in a risk-free trade. Prices continue to go the way we want them to go. They go down, and we hit this yellow undervalued level. Excellent. We go ahead and take our profits here. Okay? So great. We go ahead. We book our profits. We check the trade. We review that we did everything well. And lo and behold, when we look at the chart again, prices start moving up. Now, most of the time, it just kind of falls off. But in this case, prices continue to move up. Okay? So prices move up. Wow, it's making equally high highs here. It continues up. And then we hit these red, significant overvalued levels. We quick check the indicator. The indicator, again, is even lower this time. So we can pull the same trade again. We purchase a Delta 70 put. I'm not going to write anymore. This is kind of funny. Delta 70 put right here. Again, put the stop loss up here. Prices come down. We'll go ahead and move to break even. As prices trend along, they fall some more. It's significant, a moderately undervalued level here, and so we go with our profit right here. Excellent. So by paying attention to price movement and comparing the MQ momentum histograms and also the indicator line, we can see this as a double bearish divergence. And actually, it worked out twice for us. Okay, so we had two opportunities to trade here. And the very cool thing about trading tick charts is this trade started about here, 933, we saw the first high, and then by the end time we took our second profit here is 950. So this trade, these two sets of trades and the setup occurred all within 17 minutes. So you have to be a little quick and you have to be paying attention. But one thing we do find in the options light and trading room is that after this initial bumpy period in trading, usually that there is a general trend in the first hour, hour and a half of trading. And we try to identify that and go ahead and take advantage of it. In this case, for my demonstration, these are a bearish divergence. James, your quick question was what price is the stop? Let me erase this so it's a little easier to see. Well, if this is the high right here and I'm going to go short right here, I'm going to put the stop maybe $2 or $3 above that. Okay, and again, the stop is actually identified on the price chart right here at a specific price of Amazon, but when I actually enter the stop on the actual position in the order system, I actually have to put the stop on the value of the option. Thinkorswim has a nice function called expected value, and in the options live trading room I show you how that's done, and you can actually adjust the price of the option as a stop, and it shows you a rough calculation of what the system thinks that the price of Amazon will be at that time. Okay, here prices are moving up. This red bar segment, either here or here, that's where it gives us a signal to get in. I would place my stop again a couple of dollars above that. Now, could prices poke up there and knock us out? Yes. You know, maybe next time you'll keep your stop a little bit wider, but usually when you look at the histogram bars, they provide you with some assurance that the prices may not go much higher. So you just kind of watch that. Right. I was just showing the example is I don't see a red upper bar segment here on this first divergence, and that's true. A lot of times you don't get the extreme significantly overvalued levels on a bearish divergence. I just like them because when you do see them, it gives you a really nice indication that that's a nice place to go ahead and go short. Now you want to watch the histogram, because if for some reason something happens in Amazon and you get 4 or 5 of these red bar segments in a row moving up, you're not going to see this on the histogram. You're going to see the histogram do this. It's going to go parabolic on you. Okay? But I'm just saying, if you see these red upper bar segments and the histogram stays low and it's still diverging, that's a good signal. Okay? Usually the question is, there's 2 red bar segments here. Which one do you pull the trigger on? Well, usually it's the first one you see, because you don't know that the second one's coming. But again, you see how that's messy. You can see how the red upper bar segment really isn't barely visible here. I mean, if you put your stop loss here, if you get in at this point, it's a couple of dollars, then chances are you're not knocked out. But you just need to watch it. That's why you place your stop loss, because after you get in a trade, you put your stop loss, you really don't know what's going to happen afterward. That's what your insurance is for. It could roll over, or it could continue and get 5 or 6 red bar segments here. Okay, so you have to be careful. But again, always take into account both value, price, trend, and momentum. If you trade along those lines, you're going to have higher probability trades. Right, Mike. You are correct. Mike's mentioned that I took this divergence when the MQ trend and MQ regression are green. That is correct. And a lot of times, divergences will occur counter trend. It's kind of just the nature of it, because, like in this particular case, look how long the trend has been trending upward, and it is the case that you know, we have this surge up and a pullback, surge up, pull back, surge up, pull back. Eventually, this trend does end and it turns around, but that doesn't mean that we can't profit counter trend along the way, as long as you stick to the specific setup, okay, and get in at a good value level, and then take profits where you need to. It's like in this case, if we didn't take our profits here, then we would have moved to break even, and then we would have gotten stopped out at break even. Getting stopped out at break even is not necessarily a bad thing, but it is nice to be able to take some profits there. Okay, let me take a look here. Let's go ahead and continue this. I think that is it, actually. So I've been answering question and answers. This is our question and answer section. Let me just see if there's anybody else that I may have missed here. Okay. If anybody has any additional questions, please go ahead and enter them now. I'd like to go ahead and answer them as I can. Okay. Just bear with me. Jim, you were mentioning the logic of the market profile, like selling the upper tails and buying the lower tails. I've heard people say that. It's not something, once you really understand how to use value bars and value charts, it's not a set in stone thing that we're saying, okay, this is moderately this is significantly overvalued, we should sell this. Because in a very quickly moving market, you're going to have a lot of different upper red segments. And really, to be honest, I've been in a trend trade before where it breaks through a resistance level and there's no resistance above it, and all these stop losses are for people that are short, right? Like this is the trend line, and where prices are trending up, they touch it, and they hit it, and all of a sudden these bars, red upper bars, that pop, especially on a trend tick chart trade. You'll see a bar just pop up here, and another one, and another one, and another one, and they all have red upper bar segments. That is what we refer to as a value migration, because these prices are moving up so fast that compared to what has happened back here historically, these are in the extreme valuation zones. It takes a little while for historical prices to kind of catch up with that. You'll see less red bar segments, and then yellow bar segments, but this can still persist. Okay, this doesn't have to stop. So right here, if you start seeing red bars and you have it programmed in your mind, sell the red tips, you're going to be on the wrong side of the trade, especially if this thing has legs, because this type of motion, if you check it on MQ momentum, this could have really strong bullish momentum or vice versa bearish momentum, and then this can continue. You may not see some of the red tips, but you will see it's almost like a big wave of prices. And again, it happens a lot when we break through support and resistance levels. Okay. Okay. Someone's asking about the use of leverage in options and how it compares to futures. I think it's different. The leverage of futures strictly comes from the fact that you can use a small amount of money to control a large contract worth a large amount of money, and that's kind of a fixed ratio. With the leverage of options, it's similar, but because of the nature of options and the number of different, let me see if I can go back to that slide, the number of different aspects that go into an option, that is the price of the underlying, and that is delta. That's the feature of the options price. Implied volatility, and that is vega. Okay, and then time until expiration, that's theta. Okay, I speak Greek in my options live trading room. We normally deal with delta, we normally deal with theta, and I make my participants aware of how vega affects it, because this is change in price, how it affects the price, and these are the characteristics of the price of the option. Okay, price of the option. Now, one thing, if you guys are interested in, I'm working on my first workshop, and it's going to be basic trading options basics, and I'm going to go into delta, vega, and theta. Theta is how much time is left until expiration, and we use this on weeklies when we sell spreads. So we wanted to take advantage of theta. Now, the one factor that we talk about a lot is vega, or volatility, and it's actually very important to options. Now, if you guys know, if you've been paying attention to the market, the VIX number, which is the general volatility of the S&P 500, it's been really, really, really low, and it keeps trending lower over the past 4 or 5 months because the market's been going straight up. Now, the vega for the market does affect the price of stock options, but one thing we normally talk about is the relative vega, the implied volatility of the stock of Apple compared to the vega of LinkedIn or Netflix, compared to Priceline, compared to General Motors, compared to Cisco, or even Microsoft. There's a big difference in implied volatility, and it affects the price of the option, and that affects some of our strategies. So again, if you're interested, come visit me in my options live trading room, and I'll touch on that just a little bit. So that, I'm sorry about that. That's my my mouse does that. Okay, so right there, there is some differences between the leverage of options and then the leverage of futures. I mean, it's a very interesting tool that we use in the options room. Okay, let me just double check here. Any more questions? Sean's asking, where can we find more instruction on using the indicators? I know on valuecharts.com we have a resources section. There are should be a PDF regarding the large bundle indicators in there for TradeStation. I know I've been working on the one for TOS. Actually, that's a good point. We now have the value charts indicators for the Thinkorswim system, and I was involved in creating the documentation for that. I think you'll find it very useful. So consider getting that if you use the TOS system. How many live calls do I make a day in my room? Tom, it depends on the day of the week too, but usually in an active morning we may get into 1, 2, maybe 3 trend trades in the morning. Usually it's around 1 or 2. It just depends on the market. Then we sometimes take divergences. Not so much recently, but we do divergences, and we also do counter trend divergence type trades. When we look at our candlesticks, we trade those on 60-minute charts. And then starting tomorrow being Wednesday, Thursday, going into Friday, we do some trades, spread trades. So we actually sell credit spreads, and that helps us by selling the credit spreads. We're looking for the options that we sell to lose value and possibly even expire worthless, because we've sold them and we're kind of wanting to see that the credit spread that we sold go to expiration. So those are the kinds of different trades we do. We probably do anywhere from 4 to 6 spreads a week, and we monitor them. It all depends on the economic reports that come through. And again, on a daily basis, maybe we do 2 to 3 trend trades and maybe 2 to 3 divergence or candlestick type trades. It all depends on what the market gives us. We'd never force it. So sometimes there's a lot of different opportunities, and sometimes there's not much. Okay, the MQ trend indicator. Okay, let me quick do that. The MQ trend indicator, the way I use it, oh, I'm sorry. I apologize for flipping through the pages here so quickly. Makes me dizzy too. Okay. Well, the way we use MQ regression and MQ trend, basically they identify the trend over a longer period of time. In this particular case, normally if we're doing a trend following trade, we're only going to take bullish signals. Okay. Now I know I did show you something that was opposite, because in this case I'm looking for a divergence type trade. Okay. But in this particular case, if we're considering doing this as a trend following trade, we want to be on the correct side of the trade, and it's much easier to make profits or be profitable and have higher percentage trades when we're swimming in the direction of the trend. Basically, is the way we say it in our room. The MQ regression, you can see this is not any particular line like the ADMA, but its slope is important, and the fact that it is bullish is important. Now the MQ trend, you can see it actually tends to persist longer, in my opinion, than MQ regression, but basically it provides a second point of reference to see where the trend is going to change. You see how the MQ regression is flatlining here, that we're going from green to red to green to red. Now what happens is as prices come down, the MQ trend maintains its position right here. See that? It's following the trend, it's following the trend. When the prices start to go against where that MQ trend is, then it stops going up. It provides this line, and then once where you have a price that actually closes below this level here, then the dots appear as red and start to create the same level of distance as the green did here. See that? And then right here. Okay, so this basically is a little bit more lagging in my opinion, but when they agree, it gives me a lot more certainty to enter the trade. So in this particular case here, if we're looking for a trend following trade, that is, I will only take bearish trades here. Okay, just a couple of some more questions here. Very good, thank you. MQ trend indicator, okay. Tom, the question is, in my live trading room, are we looking at live charts as you make the calls? Yes, you see everything I see when I'm actually entering trades, okay? It can be kind of hectic sometimes. Again, remember how I told you we're looking for setups on the price charts? Yes, like the chart of Apple right here. I'm looking at the price of Apple, but when I go to enter my order, I'm buying and selling contracts of a specific delta 70, in this case, put. Okay, so sometimes it's a little hairy in terms of, okay, we're in a position, I'm moving this break even, etc., etc. I'm watching. I have to keep in mind, in one case, I have to keep in mind what I purchased the option for. You know, did I buy it for $20, and then okay, now it's worth $22. Now where do I? So I get down here and I'm like, okay, I'm ready to sell. Now what's the price of the option? Now I have to sell the option at whatever price it's trading at. and what's the spread. Sometimes that becomes a factor. Now, trading Apple, Amazon, Google, it's not a problem. It's just very liquid. Okay, Apple is probably, yes, anybody in my trading room, Apple's probably my favorite, because just recently, and this is my feeling on Apple has well-defined, hold on, let me see if I can pull it up on a chart right now. I actually had this kind of ready for you guys, and you guys in my options live trading room see this every day. Can you see that? Yeah, you can see that. Okay, this is the daily chart of Apple, and sorry if we run a little bit late here. Okay, see that? We have well-defined lines that we identify first thing in the morning. Okay, and you can see to provide great trading road marks. Okay, we opened up down here. We came down, we touched this within 15 cents. Somebody pointed out in the options live trading room, and then it shot straight back up, and it went up $25, and it stopped right before 438.06, and it came back down. These are great trades. So it's almost like they're saying, okay, we're going to trade between here and here. We're going to come down, touch this, move back up, touch that, and come down here. So right there, you know, once we are at 419, we're watching MQ momentum on a tick chart, turns around, and once we know it starts turning around, we follow it all the way up like a trend trade, and then once we come to this level here, doesn't look like it's going to break through, we come back down. Every once in a while, like here, prices are coming down, it opens right on support, and remember I told you be careful with the red line, with the quote red bars. Once it broke through here, this thing really fell. Okay, but we have these roadmaps with our support and resistance levels, and we talk about that in the options live trading room. We do that for Apple, Google, and Amazon, and then we also identify them on the other ones. These are the ones we follow in our room. Kind of a little taste of what you would see. Okay, yes, you're welcome. Now, really quick, because you guys have spent your evening with me, I just want to hopefully I answered your questions and answers. I don't see any more. If I forgot anybody, please yell at me, and I can address that. But I just really want to take a quick moment here, tell you a little bit more about my options live trading room. I know a couple of you have asked. Basically, we are this is where we focus on trading setups with options on stocks. The stocks again that we normally follow are Apple, Google, Amazon, my three favorite. Goldman Sachs, MasterCard, LinkedIn, Netflix, etc. Now these stocks have weekly options that provide really good option liquidity for us and tight price spreads. That allows us to trade both intraday and 1 to 3 day swing trading positions. Normally we utilize directional puts and calls, basically what I showed you, but midweek to later on in the week we add the focus of selling credit spreads to take advantage of time decay on these expiring weekly options that expire on Friday. Now normally our trading room hours are 9 a.m. to 1 p.m. So we're in there about 30 minutes before the opening of the market, and that provides us a good opportunity to review all those support levels that you saw, economic reports, etc., current positions, all those things before we actually start trading. Now the normal price on the room is $149 a month. Now if the opportunities of trading options on stocks sounds exciting to you and profitable to you, and you would like to experience it more, please go ahead and send me an email at dave@microquant.com, and I can help you get a free pass to visit my options live trading room. I believe my open house that I normally have will be next Wednesday, but if you're really interested in it, I can get you in there earlier. Just send me an email that you're interested, and I will contact you right back, and we'll work it out so you can experience it yourself. So James, you asked Amazon, does it matter if we use the 133 ticks? Is that the lowest value on TOS? No, I've actually looked at, for Amazon, normally traded 125 ticks. There's some days where that develops really slowly. So sometimes I've looked at it with 100 tick bar chart. It just depends on how fast you want to see it. on toss, I know the 133 ticks is a default setting. I honestly don't know if we can set it for something lower than that. I believe we should, but honestly, I don't know. Okay, I'll take your advice on that. 133 is the lowest, but really with 133, you should be able to trade Amazon. You should be able to trade Google. We should be able to trade Apple for sure. I would actually use the 233 ticks for Apple and the 133 for the other two. Let me see if I have my tick charts here, right here. Show that to you. Apple 250 tick bar right there. Google 125 tick bar right there, and Amazon 125 tick bar right there. This is what my Options Live Trading Room traders see every morning. Okay? All right. Again, if anybody has any questions or would like a free pass to my Options Live Trading Room, please give me an email, and I'd be more than happy to help set you up with that. I'd really like to invite you guys to come visit. Okay? Are there any more questions? All right. Well, oops. Let's make sure I got this right here. All right. Well, thank you again for taking the time to spend with us in this webinar session. I hope you found it informative and exciting. I really enjoyed my time with you tonight. So any questions or comments that you might have, please direct them to support@microquant.com. We'll be happy to answer them. And again, my name is Dave Aquino. Thank you. Have a good rest of the evening, and good luck trading. Thanks a lot.